Thank you very much. Thanks a lot for your interest and for joining us this afternoon. It's been a really interesting conference already, and actually even happier that we can now piggyback on a lot of the things that have been not discussed but teased and mentioned already throughout the beginning of today's conference. So really looking forward to spending the next 45 minutes or so with you and a bunch of colleagues and a panel to discuss, I think, one of the most important topics for many of us here, right? Namely, how to engage with the market from a small cap and maybe micro cap, small cap, mid cap perspective. Actually, many of you I've met before in my previous roles. I personally am now the founder of Embera Partners, a boutique capital markets and IR advisory firm, but I've spent 20 years with the likes of S&P and others actually in our corporate advisory business. And I was aware that access or investor engagement is obviously a problem statement. It's a challenge. But in the last year, since we've founded Embera together with close to 20 people now, it's been amazing to see that it's the issue, literally in every conversation that we have, from very small companies, but also to larger ones. It is actually the topic that comes up most of the time. Small companies with limited access, with limited coverage, with limited liquidity, larger companies in terms of prioritizing their access. So we've not only come together as Embera to hopefully help with some of the problem statement. And by the way, today we definitely do not have the panacea. I want to be very clear. We also cannot guarantee that we can solve this for small and micro caps. But we have a couple of ideas that we wanted to bring and show and obviously also discuss with you. So we would love this to be also interactive if it's possible. I'm not, one slide back, I'm not alone here. I'm going to be joined by three colleagues, Bettina from Semperit, who you've maybe just seen in the workshop prior as well, Miro from JMS, a local investor here that is actually focused on small and mid-cap investments. So when I hear firsthand on how the corporate and also an investor use some of the current situation. And also we have George, a colleague of us, but somebody who spent 15 years with the likes of JP Morgan or Goldman or Barclays on the corporate access side to discuss that topic with you. So a lot to go through, and here is what we have in mind for you. Just a quick assessment of the current status, at least from our perspective, after a year of speaking with many stakeholders around the current problem, but also maybe the one or the other idea, one or the other opportunity on how you can use the current market environment for your advantage, actually, and then really first-hand information from the horse's mouth, so to speak, from the various stakeholder groups with Miro, with Bettina and George. And hopefully, again, if you disagree, which would be the best thing, to get into a discussion or have a different opinion or views, we would love to have that discussion because I think this topic is ever evolving. So let's, and then obviously Q&A if we have time. What's the state of things? I don't want to spend too much time on the problem statement, but I think pretty much everyone in the room here will have an understanding of that. We specifically have a small cap dilemma, which is especially true here, but it's actually the same thing in the UK. Under a certain size of a company in terms of float capitalization, the recent regulatory changes with MiFID that have just been intensified over the last couple of years really make it difficult to have proper coverage that has been existing in the past from the broker landscape, etc. So things have truly changed. So low liquidity, under a certain liquidity threshold, it becomes very difficult for the buy-siders to actually really take a position and, as you know, come out, which is becoming even more important. The limited float capitalizations of a lot of the smaller companies who might still have a founding investor from a family or a core investor is sometimes an issue. And then obviously the regulatory changes, which you know firsthand over the last couple of years, have not made it easier. And I'm not even talking about other trends like the continuous shift to passive investment, which minimizes obviously the part of the market that you can activate, or other topics as sustainability integration, and kind of the gray area on what that really means for the buy side, how do these stakeholders take decisions, and many, many, many others have led to a situation that makes it a lot more difficult for smaller companies to actually have the proper access and investor engagement. And over the last year, this has come up, as I said before, obviously numerous times, and a lot of times what we hear, and there was the workshop before, strategic IR, strategic engagement actually is not only not possible, but people don't have the time because they're stuck in reporting or CSRD or other areas. So I think that's not news to you. That's where we're coming from. But is there also an opportunity? And based on our engagement with the market, there is. There needs to be. Because when you actually speak with investors of all sizes, actually, very large houses like T. Rowe Price or Henderson or Schroders or Fidelity's of this world, but also obviously smaller ones, they are very clear that especially now, actually today or right now, we've been for the first time, it's the longest streak, the longest cycle of an overperformance and outperformance of large caps vis-a-vis small caps, and the focus on tech that has ever been happening before. So usually it's around 7 to 8 years. This is lasting already longer. When we speak with them, it's very clear to them that they come back and said, you know what, it's time now, the time seems right that European small caps, international small caps are becoming interesting again, because purely of the valuations and the value that can be created and that will be created if the market environment changes a little bit. And these are, for the most part, all very recent research pieces, which we can obviously send to you as well. And it also covers all types of investors. So there is already a little bit of an appetite and also an opinion that the market has created such inefficiencies that it's a question of how can you actually tap into that opportunity that might be already here for you in your organization now, because obviously it depends a little bit on what industry you're in, or also that might be around the corner. And here is one of the things that we want to show you. That's also our approach as Envera Partners, a very data-driven approach to corporate access and investor engagement. But it's also something, this slide comes directly from the investors. We've spoken with them, with I think 60 or so investors over the last couple of months, and talked about that topic with them. And one thing they came back with to us was, a lot of times it starts with the actual equity story, that especially a smaller company or a new company to the capital markets or a company from emerging markets, it's not clear to the buy side on why, if I'm the investor, I should either invest in you or I should spend an hour to do the proper research so that you get on my investment radar if you're not already. So that translation from the business case, and these are kind of as a summary of their words, which you obviously know, the inside-out perspective, that translation from the business case to the investment case into capital markets language that has two sides. Number one, a story, a narrative, something that's easy to understand for the buy side, supplemented and substantiated with actual data points that the buy side can use, or actually the entire ecosystem can use, can assess you with, and can track you in the future, is something that has come back to us very, very clearly, that a lot of times it actually stops with the lack of equity story, the clarity and the convincing equity story that especially smaller companies might not be able to present in an elevator pitch. So the definition, number one, of the KPIs, that if you would want to narrow it down to maybe 5 KPIs that substantiate your storyline, is something that you might want to consider. How are you currently pitching yourself, and how would you quantify this in 3 to 5 KPIs that you would want the market to measure you? That's what came back with as the first point from the buy side, actually. The second thing is, and we heard it throughout the entire day today, that's why I was referring to it in the beginning, the market has completely changed. So I'm, as you might have heard before, I'm from Austria. The Austrian market is very, compared to Switzerland, very small. It's even more difficult for most of the companies there. to get access. But a lot of the companies listed there, actually, if they're honest about it, do not understand, or they have no clear picture of how the landscape has truly changed over the last couple of years. And I would say it's probably true across the globe. The smaller you are, the less of a feeling you really have what has actually changed. And one thing is definitely true, that the sell-side coverage and the broker model as it has existed 10 years ago is gone. It's just not going to come back. It's just, people still expect this to happen. That has changed as well. And we're not even talking about these other points here that truly have changed very rapidly. And we are completely disrupted also by two things, by technology and by data and by AI and a combination of things. Not only the IR function, but also the buy-side function. So having an understanding of your KPIs, your equity story in the first place, is really important. And the second thing is an awareness of the main trends and developments that affect the market and your individual company, because that will be different depending on which sector or industry you operate in, is truly important. And it's something that is actually now available at your fingertips for the most part. The slide or the chart on the top right there is something where you basically are now able to track any data, any information that is being written, communicated, reported, commented about your company, your CEO, your communication in real time. And investors are already using it. The question is, are you aware of this? And are you also considering using this or using something like that already? I'm not saying you have to use it, I'm just saying this is available and it's at your fingertips so you can understand what the market is actually thinking about you, what the sentiment is globally at any point in time. And before you go out, it's probably good to know, because it's something on how you can refine the equity story or your pitch to the individual investors better. And I think on the SGS interview, it was very good, because your pitch fundamentally should stay the same, but it might be different depending on which type of investor you're about to meet. And if you understand how they think in terms of their decisions to allocate money to you, it's probably also good to know what's their ecosystem and how are their decisions being influenced by data, by ratings, by scores, by other things. And then obviously about the local market, which here in this case are some statistics about Switzerland. And I was pleasantly surprised actually that it doesn't take so long for a small cap here, for an investor who wants to invest in a small cap, to really build a meaningful position. These numbers look completely different in a market like Austria or other markets where it takes like 2 months. So basically you're uninvestable for a larger fund. But what's the story? So think about your equity story. How would you define some of those KPIs? Do you truly understand some of those larger developments in the market? And then I think that strategic approach to building your cap table with the opportunities and the possibilities that you have in your company. Some might have no coverage, some might have 2 broker partners, paid, unpaid, some have 10 or more. Understand your equity story and then go into your current owners. This is just an approach that we've tried now the last year, but it has also been, it's not a rocket science. What's your KPIs and what's your equity story and how does that fit into your current ownership profile? Because if it fits well, there might be upside in your current owners to allocate more money to you. If you're an outlier in the different portfolios of the Fidelity Small Cap Fund and you actually don't fit into the center of it, you should understand why. So number one, that means potential risk of further selling, right? So you can map that profile that you've created yourself to the current owners to understand risks and opportunities and start a strategic process and where do you need to spend your time most effectively. And there are other things that you can then do, namely understanding their investment policies, liquidity thresholds. A lot of us have active and passive investors, retail investors. What are means to activate them? Do you have an engagement record actually with the current owners? Because if not, that's probably the first thing to do. Actually, do you know them? And what's the ecosystem around them? What's their broker partners that the buy side uses actually? Because if everyone is using Kepler Chevreux as one of their broker partners, it might be a good idea to try to work with Kepler on your next roadshow, right? Using the ecosystem that maybe the exchange that you have, etc., that you can leverage the story. So I'm trying to just break this down into simple things that either have worked well or that are really guided by the market. So after you've defined your story, look at your owners, and you can then take the same lens and look into non-owners. Where does that profile that you've created actually fit well into current non-owners who can buy you? Because you might be the greatest fit for a fund in France, but if they only invest in France, then it doesn't really make any sense. But there are plenty of them, and if you know what's important to them from their investment decision-making policies, you also know better how you can pitch in that meeting, because that might be a lot different from investor to investor. And the last part I want to say is, the title of the presentation also says holistic investor engagement. A lot of times we're forgetting that there is an ecosystem around the investors, including sustainability, corporate governance, softer factors that are truly becoming a lot more important for them in their decision making. Maybe you're screened out because of the ESG screen or other associations that invest, right? So you need to become aware of that as well, and that's possible through available platforms actually that you probably already have. I just want to put that as a separate story. And before we now shift to the actual discussion on how companies or stakeholders are already doing this, we've tested this, and it's been tested by others as well. By taking an approach like that is customized to your individual story that you've defined and that you can basically then test and map to the different portfolios. You minimize and you shrink the portfolio, or the global universe of portfolios, obviously from tens of thousands to a few in each city. But they are the ones that you need to find a way to activate independently or with your existing broker network or partners, because they are the ones that also, if you test it out, have a higher chance of being interested in your story. Why? Because they're actually already taking decisions that way. They're fundamentally already taking these types of decisions. And by applying a data-driven approach to that, including understanding on how these stakeholders and what's going on in the capital markets generally, what information they're using, you can prepare a lot better to then have that actual strategic outreach, get those engagement records set up, get the qualitative overlay, and obviously strategically plan your outreach, even though it might be minimized to a certain region because you don't have the full coverage. But it's something that you should think about, because there's so much intelligence out there right now in both directions, from the buy side evaluating you, but also turning this around from an IR to the buy side, that this is something that can probably get you on the map easier and more effective than before. So that's just a collection of things that we've heard and that has been actually mentioned by some of the buy-side community, and also our general approach based on our experience. But I want to actually now invite Miro, George, and Bettina to hear a little bit on how they not only see what I just mentioned, but how they are taking decisions on the day-to-day themselves from the different perspectives that they have. So I would welcome you to now.
Do we sit under our pictures?
No, I think that's, I think
Otherwise we don't know who's who.
you probably
You would
don't.
not recognize that.
So, maybe it's easier for me to stand here. So, I would like to start with Miro, right? Because obviously the entire capital markets landscape has changed quite significantly, and you're representing an investor who is actually actively looking for also smaller and mid-cap stocks, to create value for your own portfolio. What would be great is maybe you can explain a little bit your process and what is important for you. What are the factors that are important for you so that a company that might not be in your immediate investment radar becomes interesting to you to consider? Maybe you can explain a little that process.
Sure. Hello, everybody. My side, I know a couple of people here. It's obviously a small community, the Zurich financial space. Some I've met for a very long time already. Some of you I know since probably almost 20 years. This is basically already the first, I think, important factor. So of course we have our screens, like liquidity screens and some kind of market cap screens. But most of the listed stocks, they qualify, like, or you can always make exceptions, and it's not a very rigid thing. But what is really a completely different thing is if I know somebody in the company, especially the IR, and for example, Doris here with R&S Group, who was listed a couple of, quarters ago, when she calls me up and tells me, hey Miro, you have to listen to this story, it's a super interesting thing, then I say, okay, Story is calling me up, of course I listen. Or Tim we spent a lunch 2 hours because he told me, from Rieter now, he's with Rieter, he told me, hey, Miro, look, it's really changing something now, you have to listen to that. And then of course I know Tim since a very long time, then I'm going to listen to him. So I think meaningful relationships is the best thing if you want to get the attention of somebody. And how do you build those? Probably you're more elaborate on this than I am, but I personally, I'm also looking to build relationships with the people within the companies. And I think the one-to-one communication is very important. I go to lots of conferences, we have small group meetings, I don't really like them a lot, because it's not, nobody is prepared, it's not personal. It's completely different if you have a one-to-one conversation. Just an example. And of course, always tell the truth, don't lie, because once you've lied, I never trust somebody who's lied to me. So that's, of course, that's the basics, right? But building meaningful relationships, I think that should be one of the big goals being in investor relations. I prepared like a bit talking to investor relations. I know that there are other people also in the room, but that's, I think this is important as the first thing. Then the second point I think is important is the way how you communicate, that you communicate well. I've had hundreds of meetings with IRs which were completely useless. You don't get what you're looking for. You want to get a feeling about how it's going on and what is going on in the company. And many IRs, they are very well in basically answering questions without saying anything. And then you have the meeting with the CFO or the CEO, and bang, it's very simple. They just answer a question, you have it. And so that's, I think, something you can really work on to align with your CEOs and your management, that you are allowed and dare to speak what is actually happening in the company. And you can also speak from the I perspective. I think that, I see that, we know, and not just, it's like that. So really take responsibility of what you say. I think that's the communication. Secondly, when we talk about communication, the holy grail is beat and raise, obviously. You always want to avoid profit warnings, and you don't want to be in a trap of being in a situation where your guidance is here and your true expectations of the business is here. That's the holy grail. Obviously that's super difficult because it's somehow self-adapting, right? Because every analyst, they know that you're lowballing after a while, so that's a very hard challenge. But you definitely always have to work for that, to be able to beat and raise. Don't take any risks with the guidance. Swiss companies are quite good at that, I have to say, compared to Austrian and German ones. But that's the holy grail. And thirdly, it's what you probably know from momentum. You have to communicate to fuel momentum. Momentum is, for me, it's super important. There are so many great investment opportunities out there. I have 20 slots in my portfolio, maybe 25, and I have an investor letter going out every month. And I cannot be wrong for a very long time because they just redeem. So I have a lot of pressure, and I need to allocate capital where the momentum is. And you have to make sure that you have a very long time of upward momentum and a very short time of downward momentum. I think in capital markets, like, prices go up 80% of the time and 20% of the time they go down. This is ideal. I have many companies where it's going down for 80% and then 20% up and then it's going down. That's the wrong way. It should be the other way around. So 80% it should go. That's your, obviously also business related, right? But it's mainly also a question how you communicate. Build momentum. Don't fuel or don't put oil in the fire, once things are going well. Make sure that you calm down if your stock price goes through the roof, and if it's going down, then you maybe put some supportive wording. Because I want to have a peace of mind also as an investor. I want to have volatility all the time. So that was the communication style. The first part was basically about the relationship. The second one is the communication, how you should communicate. And I think the third part is really what you have mentioned, and then I shut up. Is really the equity. It's really the equity story, and I think this is really CEO topic. Even in Switzerland, it's board of directors topic. It's not your main concern. The equity story should be at the heart of your strategy. That's my personal view, and this is so important for me personally. What is equity story? It's change. I want to know what is going to change in the company going forward in the next 2 to 3 years. So it's not just, look, our stock is cheap, it's trading at 8 times earnings. That's, for me, it's not an equity story. And actually for the market, it is not, it's the same, right? If you look at the stocks which go down, it's the cheap stocks. The stocks which go up are the expensive stocks. So the equity story is basically what's going to happen going forward, and how is this going to affect basically the equity portion of the capital structure. That's called, for me, this is called the equity story. And I look at the company like it's an animal or like an kind of organism, and I really want to have a clear picture how this organism is going to develop going forward. This is really the equity story. Now, if you are a small cap, the most important thing, if you have an equity, if you work on your equity story, make sure it's one story only. One story. R&S, it's about transformers. Point. Very simple, one sentence. Sorry, Doris, if I use your company, but it's very well done. It's like it's very simple speak. I was invested in a company, still I'm actually invested in a company called SIG Combibloc, or SIG Group. It's a fantastic story. It was a fantastic story. This milk packaging, market share gains against Tetra. Really, they did everything well. This thing grows like a clock. It's fantastic. There was one simple story, and everybody could understand it. Trading at 35 or 40 times earnings, and fantastic. Then they did 2 acquisitions, and everything was dead. Now it's super complicated. Acquisitions in other businesses in the US, in China, and fresh milk again, and fresh milk again. You just don't, you cannot tell it in one sentence anymore. And it's now trading at 20 times. It's hard to, the story is basically evaporated. Now they need to work another 5 years to make it a great story again. I'm sure about it. So one story only. I think that's the most important one.
I think that's a good lead actually to Bettina, because Bettina is coming from a larger organization into an organization that is not so easy. It's a little bit complex, actually. And Bettina, I would love to hear a little bit from your background now at Semperit on how are you trying to revamp your capital markets present, within Semperit, with various channels or via various channels, to kind of reposition Semperit in front of the capital markets and stakeholders like the buy side, but also like portfolio managers, but also other stakeholders. Can you share a little bit on what you've done since you came into the organization? Because I think it's representative, or the challenge is representative of many, companies that are also in the room.
Okay, yeah, I would like to do so. So yeah, I joined the company 1.5 years ago, so mid-July 2023. And back at this time, Semperit has a 200-year history, so in a month from now, we are celebrating our 200th birthday. with all ups and downs. And when I joined the company was again at some kind of inflection point. So meaning there have been a lot of changes. We were divesting one part of business with regard to medical clothes. At the same time, we were investing into a new elastomer business dealing with liquid silicone rubber. Additionally, we did a new segment reporting, formerly 5 segments, merged into 2 segments. So meaning there was a lot to communicate and a lot of change for investors again. At the same time, as you have mentioned, also due to the, I would say, overall economic situation, the share price, did sharply reduce. We are now, in the middle somewhere. It's depending on the definition between micro and small cap. So meaning the definition how long it takes an investor to buy 1% of the free float or of the overall stocks is more or less the same. And we started at one of the first things was, and I think it's in line what you have mentioned before, to shape our story, to shape our narrative, and also to go more on the outside. So meaning not only with regard, I mean, of course, the 200-year topic was a nice additional momentum which we used, but we engaged more heavily, because it was also mentioned today, with some, from an Austrian perspective, with some financial influencers. We did some cooperation with financial platforms. We more engaged with the financial community, taking part, for example, with some Austrian banks. There are still some investment clubs, so we tried to get space there. We did some summer events for the financial community. So really telling the market more about Semperit again. Here we are in a new shape. We are, of course, in a difficult economic situation, more or less at the bottom of a cyclical development. Nevertheless, we're used to manage such situations, and we have now really a very, very solid basis for further growth. So meaning this was one point. Additionally, and I've mentioned before, I have a background as a financial journalist, we also tried to a little bit have our own news flow, and therefore we decided to make an additional website where we promote not our 200-year success story, telling the market that's Semperit. And I mean, I made the experience that is, even when you talk with institutional investors, it's interesting for them if you tell them, hey, okay, if you go skiing, there is no skiing day without you are getting not in touch with a product from Semperit, because with regard to ski foils, we are #1 in Europe. Most of the investors I talked to were not aware of it. So meaning these are small parts, but you are also getting some glimpse on the company. And of course, we also promote all these stories and news via social media. So we do not have a large spectrum, but also with regard to LinkedIn, we depending on our small team, we try to do our best. And the other important part was that we decided to do a perception study. I mean, of course, as most of you, we are in regular touch with investors, with analysts. We know their pain points. We know many reasons why they like us or why they do not like us at the moment or are not satisfied. But for us, it was important. I mean, it's quite. If you as IR go to the management board and say, okay, I now had 5 meetings and they do not like our capital allocation policy, or they are not satisfied with this and that, it's quite fine. You have an ear with your management board, but it makes a difference if you do such a perception study, which is done more or less on a neutral basis, where investors and analysts also can stay anonymous. This was also the case in our part. And it's absolutely okay. And we did this perception study and in May and June last year, and out of the results we developed a more or less to-do list for us as capital market teams. Of course, you as a company cannot change each and every pain point, but we started to do so, and of course started with some low-hanging fruits, like inclusion of midterm guidance, like more clearance, what are the basic assumptions for your guidance for the current financial year, also with regard to some ESG data. I mean, of course, we are reporting ESG data, but we also now try to give the market a glimpse also inter-year, on quarterly or half-year basis, where are we with regard to our targets from our own assessment? Are we in line? Are we overachieving, or have we still some work to do? And I mean, there are a lot of things to do, but I think really the low-hanging fruits we have already earned, and with regard to the others, we are still working, and some of it is also that we have initiated some corporate governance meetings with our supervisory board. It's the first time in our company's history. It's also that we are going to have some additional corporate access and outreach campaign. And you also have to handle disappointment, because I'm fully aware not everybody in London is waiting for us. But it's also a come and go, and if you do not have time this time, so then we will try in 2 months or 3 months from now.
Yeah, so a lot going on Semperit's side, which actually hasn't been happening there before, and maybe later you can also share a little bit, like in terms of how the market cap and all of these sides. I want to hand to George, and also if you already have questions potentially for the participants, please don't hold back. But George, you have close to 20 years of experience in large bulge brackets, actually covering small caps and larger caps, right? And have seen the transformation of that corporate access ecosystem, I guess. I mean, a lot of this we know, but why is it so difficult for small companies that are really, good, well managed, etc., to get the meetings, to get the access with a new partner, but also with existing partners? Because we obviously hear that even if you have a broker relationship and you want to go to London, the outcome a lot of times is not satisfactory, or you always meet the same people. Can you share some of the dynamics maybe on how you've seen this change, and that people need to be aware of, or should be aware of if they are not already, to avoid it and to ask the right questions?
Yeah, sure. I don't want to spend too long on this, because I think everyone's going to be depressed, very depressed, if we do. But ultimately, everyone knows the story, right? MiFID II has caused a massive transformation in the marketplace for investor relations people. Coverage level, reduction of coverage across the sell side has been prevalent. The focus of the sell side on a subset of, certain clients, largely the ones that will overpay for research consumption or research services, and separate that obviously from trading commissions, means that there internally are great pressures on the sell side to allocate resources, and by resources I'm afraid I mean you, the IRs, or your CEOs or CFOs, to their most high-paying clients, i.e. the hedge funds, which makes it really, really difficult. There's a huge tension internally that has built, and I think to a degree, from what I've seen over the last 5 years, brokers have become less and less, or the sell side has become less and less able to say no to those higher paying clients, because they make it so commercially viable to do it that way. Now, I know that there are plenty of large, extremely large, long-only institutions, the Capitals, the Fidelities of this world, that have really struggled to get the meetings that they've wanted with large cap companies, as part of their roadshows, because of that tension. So that is what we're faced with. And that's at the large cap level. We've also seen the role of the equity salesperson change, I think, a lot over the last 5 years. I think we've seen a movement away from sort of idea generators, the pseudo PM, to more account management, which means having a salesperson as a champion for your stock as a small and mid cap is going to be harder to find. It's not to say it's impossible, but historically, again, from what I've experienced, I've seen a lot of experienced salespeople have very strong relationships into investor relations and issuers. And I believe that that is diluting as a result of this focus on investor account management. So I think there's an issue there. We've talked about liquidity. I think the liquidity threshold's clear for everybody. We understand those. And I think, I think that capital example is the one that for a lot of investors is the one that resonates with me the most, because they are having to therefore take the fight themselves to companies that they cannot resource into every company. And therefore I think it becomes incumbent more and more on IRs to actually fill that void themselves. And with that becomes budgetary pressure for yourselves, it becomes a resource issue, etc., etc., etc. But there are solutions, and we can move on to those. But it's not a pretty landscape, it's not easy, lots of pitfalls, but that's not to say that everyone should give up, because where there is adversity, there is always an opportunity.
So Miro, how would you want a company to build a relationship with you? Because obviously, we understand that's important, you need to build it, but how should that look? I mean, if you have a company that you have never met before, how would you expect them to approach you? Directly or via the brokers? How do you use the broker ecosystem that you might have in the distribution network? Can you share a little bit on maybe what's the advice, to companies on how to best build that relationship with somebody like you and your peers?
Sure, so I completely agree. I mean, the thing has completely changed. The number of players. We heard another one this week actually decided to work with Stiefel Zurich. Basically, the Swiss team now moves over to Odo, so that's just the next one, basically. So this is really happening. I think more and more resources are basically being moved to the buy side from the sell side. I cannot prove that, but that's my impression. Also, I think liquidity-wise, it's actually not so dire. So, of course, what you see on Bloomberg is basically not looking good. But if you want to sell and buy a stock, there is actually, I think, always very good liquidity. You have through dark pools, through blocks, through so-called systematic internalizers. So there is actually a lot of liquidity there if you need it. So for me, that's not really a big change. I mean, of course, now small caps are low, so in dollar terms it's lower, right? But in terms of number of shares, for me that's not so important. How to build relationships? So first of all, I mean, we work with around 10 execution brokers and research houses. So all the local players. So we are focused very much on the German-speaking area. So we work with everybody here, or almost everybody. In Germany, in Switzerland, in Austria. And of course, if they call me up then with a new idea, then probably because I know the guy, I'm prepared to listen, of course, as I've already said. But if I were you, I would not, I mean, of course you need to work with partners like, Embera and brokers and stuff like that to make sure that you have a proper equity story and you know the people. I think that's a given. With paid research, if there is no unpaid one, you have to pay for it. It's just, you need to have them. But if I were you, I would really start by picking up the phone and calling the ones that you know, and then ask questions. I rarely get asked a question. It's interesting, because I'm looking at stocks since 20 years, and I have hundreds of meetings, like 300 to 400 meetings a year. So if you after 20 years, that sums up. And I've seen really, I would say, I'm not on that gray hair, but I've seen many successful stories and less successful stories. And I rarely get asked the question, and it's funny. I think it's funny, because I can ask all the time. It's very convenient for me. I learn every day. And I always think, okay, why don't they ask? Actually, some do. It's typically CFOs and CEOs. They call me, and sometimes no. One called me up and said, hey, we have shorts building up in our stock. How should I deal with them? One a CFO calling me up, honestly. He's like, hey, the shorts are building up. And I said, hey, that's great. Do you know who it is? Yes. Call him up immediately. First of all, it's your most likely buyer. This guy is looking at your stock every day, and he's considering buying your stock. Every day he's considering. So talk to him. Secondly, people say this is called smart money, so long shorts, right? Probably has reasons to pay a lot for the lending and for the financing to be short. Why is he short? Do you know why he's short? And if not, then find out immediately. It's for your equity story super important why the guy is short. Maybe you remember the financial crisis. Many CEOs, they bought stock in 2008 and they were angry at the market because prices kept going down. They were angry. I had meetings with angry CEOs and CFOs at that time. Really loud, speaking loud. Why? They were losing money, their own money. They were investing their own stocks. Why is it going down? I don't get it. And we learned why it was going down, right? Because the market always knows better, typically, with hindsight. So if the shorts are building up, that's super important moment in your equity story. It should be basically for the board of directors and CEO be super alert. And then you need to be able to pick up the phone and really talk to these people. You know them after a roadshow. You know these people. You have met them. You have their cards. Why don't you call them up and ask directly, not in a news like with a link or so where you can send your answers via email or whatever. I don't do that. It's for me. It's not worth the time. But if you call me up, tell me, hey, what do you think? Then I have to think. Well, okay, now interesting. Yeah.
Gonna get a lot of calls now. Really.
No, but really talk to these people. This is how you build relationships. And many relationships that I have are actually, they last longer than the employment contracts. So I know many of the races I have from people who jumped the company a couple of times, and I still know them. And with every new company, the relationship actually goes up in quality.
So the short example actually that you mentioned there is something that is interesting because MSCI, obviously the rating firm, but also kind of influencing a lot of the passive money. Recently, and I can send it to you, published a small cap research paper where they look into what's quality and what kind of are two factors that you should look at, and it's short interest in your stock, and then the other one I forgot. But it's basically a lot of people do not really track the short interest part of things, which actually, if you take that out, significant outperformance. So it actually is a really good indicator there as well. Lorna.
So Miro, where do you go to find new ideas? Because obviously you're in a fortunate position, you've been in the industry for very long. How do you, and you've got your 20, your 25, for the benefit of those that aren't on your radar, that don't have enough research coverage, that you get called by the brokers that service you, how do you find those companies and what advice, without them cold calling you, which is clearly one option, but if they don't know who you are or know how to get hold of you, how do you approach it from the other side?
So I'm a specialist, so I think we know pretty much every company within our universe. We have screens, so every morning I get like a quant screen, in-house solution where I get basically momentum breakouts, new lows, stuff like that. But I would say there is rarely a company in the German-speaking area which has more than a couple of €100,000 of daily turnover, which I don't know. And if I don't know it, typically I've heard it and know what they do. But so IPOs, obviously, then you have to look at it, and that's for sure. But yeah, it's really the new ideas. They come through brokers and through maybe other service providers. But cold calling, if somebody calls me up, then it has to be a very good equity story, and it should be like an aha moment for me. Oh, how could I ever overlook this company? I have one addition, like quality, because you mentioned quality right before, like this short interest. So quality, if you are a small cap, quality is what you should strive for. And this should be the business strategy, should be, make recurring revenues, make high margins, stuff like that. That should be the CEO thinking. We strive for quality, but also you as an investor relation should strive for quality. And this is because, like, if I look for a small cap, and I think most experienced small cap managers do so. I'm not everybody, of course, but most, they look for high quality small caps who grow fast. So because if you add small caps to your portfolio, you want to make performance. You don't have these for defensive reasons or stuff like that, or for yield. Typically, you don't want to have small caps to take a large dividend player, Swisscom or whatever, insurance company, a bank or so. We want to have upside and momentum, and you don't want to take too much risk. And this is where you want to have companies with high margin, and which are high quality, as considered high quality, high returns on capital, growth, stuff like recurring revenue, stability, balance sheet, and so on. And you as an IR, you can make a huge difference in the perception of the quality. Because, I give you an example. In Switzerland, there is this, I don't understand, we have half-yearly reportings for many small companies. I just don't get it. If you go to the rest of Europe, it's very clear that you have, even in the entry standard in Germany, you have like every quarter the full P&L and cash flow statement. But in Switzerland, people think that's not necessary for some reason. Quality is if you provide the full transparency. Transparency is quality. Consistency is quality. So the way how you speak, how you phrase things, how you every year you have like the same way of giving guidance. So like you give a range, and then after Q2 you narrow down or stuff like that, right? Or you don't give after Q2, you don't give guidance, but after stage 2 you give. So the way how you communicate is really also for you the best way to influence the quality, the perceived quality of your company.
So communication and relationship is something that I take away, quality or the definition of quality. Just getting an alert here that we're kind of closing out soon. So maybe I want to finish with, both from a corporate perspective, but also from more of that investor engagement perspective, also 3 things that you either have tried or that you're in the middle of that have kind of worked for you. What can companies actually do in the gloomy environment that we're facing that, have a potential to unlock capital or improve the relationship with the buy side? Maybe Bettina, because I know you're in the middle of it, that's why.
Yes, so there are many to-dos. Some quick examples. One thing we did was, we called it not Capital Markets Day, but Information Day at our new acquired subsidiary, which I mentioned before. It's in the LSR, liquid silicon rubber business, which is an elastomer, but it's not so typical for Semperit. And here we received, so at the beginning when we acquired the company, we thought it's quite clear. This is, on the one hand side, we sold business, now we are acquiring to enrich our value chain in the elastomer business, but we received the feedback from many analysts, from many investors. So we do not have the full rationale, so we do not fully understand the acquisition, so we did an information day or 2 information days to show RICO, to showcase RICO. With this respect, it was also very important for us, or for me, it's very important also to give the stage to the operating people. So because sometimes you have the question, can we let him talk to the financial community because he is in the operating business, he is the managing director. So please, of course, give them a short briefing, but do not fear too much. So meaning this was one to do for us, this information day. Another initiative we have started, I've mentioned it before, is that we do corporate governance calls with our supervisory board. Also, not only, but also to get in touch with passive investors. We are just in the middle of it. It was the first time I did it in a former company already, but it was the first time for Semperit. And here my experience in both cases was that it is also very, very helpful for the supervisory board members to hear themselves the recommendations and the thoughts of the stewardship teams. And for me, in both cases, of course, you never ever can fulfill each and every recommendation, but it is quite a learning process, and there is still, after each and every call, discussion. Okay, we were not fully aware of it, so let's probably change it. And a third recommendation is, and this is also my own experience, be annoying, but in a charming, in a positive way, especially with regard, when you have existing partnerships with brokers and they have their flagship conferences. So I made the experience in the last month that there has been some flagship conferences. We have always been invited for the last 6, 7, 8 years. And now we recognized 2 times that we have not received any invitations. So we called the broker, we asked why we are not invited, and received a number of explanations, new format, Greek companies, new boss, and things like that. And we managed to get into it, also always with the remark from the broker side, but please, okay, we have a wild card, you can attend, but please be not angry with us if we do not get any meetings for you. And then we say, okay, of course, we are not angry with you. And it worked quite well in both cases. So in the first case, the bank said, we are not sure if we can arrange any meetings for you. And in the end, we had, I think, 6 meetings with 9 investors. And this was, so keep the ball rolling.
George, you have 1 minute, I hear. So
I would definitely agree with particularly 2 of those points. On the conferences, I'd also think laterally about how you might fit with thematic conferences more. The market is flooded with thematic conferences. It's how research is being paid for fundamentally now, particularly amongst the bulge brackets. So definitely work out where the read across is for your stock and how you might fit into those. I would definitely make your brokers work super hard. Be annoying, as Bettina suggested, and also engage with equity salespeople. Who else do you know within a broker? Not just corporate access, not just the analyst. Is it the M&A team? Is it the ECM team? Are there equity salespeople that can help you with your distribution efforts and be your champion? It becomes about selling more and more. Also work on your collateral. Obviously, have the elevator pitch. Have all of the IR teaser or the document available on your website that's easily accessible. And I would also think, the biggest thing for me and what I'm hearing from a lot of people today is demand resource from your management teams to help, scale the gap that has built between, the old days and where we are now. And then you can do excellent investor targeting. There are lots of different processes out there, but there are some that are definitely better than others. You can get investor perception, you can pump all of this information into your CRM tools, you can be way more on the front foot in your conversations and your relationships with the buy side. And as Mira said, ask questions of the buy side. What are their processes? Do I need the relationship with the analyst? Do I need to sign up to an investor relations or corporate access platform in order to even be considered for meetings? Fidelity runs one. You should look it up if you haven't already registered on it. Understand how those processes work. I was speaking to Henderson earlier this week, Janice Henderson. Their assistants have to be on the assistant has to be on every invitation to each PM. So make sure you understand the investor base that you're targeting. There are lots of places you can find that information. Brokers have been a good source historically, but there are lots of specialists out there that can help you. And if you are off the radars of brokers, just force them to think otherwise. Demand their attendee lists from conferences. If you are lucky to be invited, work out who's on your key sort of prioritization list, etc., etc. But I think that was about 90 seconds.
was a little bit longer, and I do appreciate, the fireside type chat here. Thank you very much. If you have any questions, I think everyone is around here for longer. And last thing, you'll also get at least an invite for a corporate access study by university, completely anonymous, to also help exactly that cause. How can it be improved for small and mid caps, and learn from how others do it in the future. So thank you very much. Hopefully that was some ideas of interest, and thank you for the invitation.